All right, my friends, there are many reasons I started the Heritage Wealth Planning YouTube channel, and I'm not going to get into them all here today, but one of the reasons is to educate people on how bonds work. Bonds are literally one of the most simple investment concepts you can possibly imagine. Just one tier underneath certificates of deposit, all right? We know how certificates of deposit work by and large. If you don't, that's fine. Put in the comments. I'll explain on CDs for sure. I got to do a video on brokered CDs as well, so don't feel bad if you're like, I don't understand how that works. Man, I get it. I was there. I was there. Maybe I'll go into some of my own stories about my own struggles to get understanding about financial education. All right. But I do want to talk about bonds. So let me share with you a story I had maybe going 13 years ago, 2000, 10 years ago, 9 years ago. I'll never forget. I went to this guy. He had a farmhouse in Pennsylvania, probably 40 miles outside Philadelphia, and we got paid if we were able to get people to go into managed accounts when I was at USAA. All right, so this guy had so USA Mutual Funds, and the funds are fine, but that didn't do us any good. We got paid to put people into managed products, and actually, one of the managed products I did like at USAA, and I don't know if I do anymore because I'm not sure what's going on with USAA, is their bond portfolios. Because USAA, being an insurance company, was one of the best and biggest bond managers out there. And so for a nominal fee, I think it was like 55 basis points or something like that. I can't remember. But you could get USA to actually buy a portfolio, build you a portfolio of individual bonds for which they did their own due diligence, not just relying on the credit rating agencies. Now, the problem with this, though, is that when I show them what the corporate bonds that we're going to be buying, most likely, we never knew because it could change on any given day, the yields were so low. And we're talking 4.5%. This is like 2009. 10, something like that. And he's like, man, why would I do that when I have your corporate bond fund, USAIX, has averaged like 9% a year, 8% a year, 7.5% a year going back to inception, which is, I think, like in 1982, something like that. And I said, because you can't look at previous bond rates of return with future, you just can't. They're completely, they're not, there's not in the same universe at all. The previous rates of return on bonds, to include the total returns, will never be accomplished again in this environment. It just won't. It won't be ever. There's no other way around that, because what happened was you could get a 30-year bond in 1982 that's paying 15 and a quarter. You can't get those bonds today, and that's what I told them in 2010. And the same thing's applicable today. Now you're getting 3% bonds for a 30-year. I mean, so those days of getting 8% rates of return on bonds are gone, and he just couldn't fathom that. He couldn't fathom it. He's almost like he was like thinking as it was weird. I could tell he just didn't trust me. He's like, I don't believe that. Why? And it wasn't like he was saying I don't trust. He's like saying, why would you put me into something where I'm going to get, say, 3 to 3.5, maybe 4 over the next 5 to 10 years, what were the fund that I'm taking it from has averaged 8% or whatever it was, is pretty high, going back to this inception. And I went over this time and time again. He didn't get it, and that was a painful experience for me because I drove out there. Anyway, long story short, he didn't buy. He couldn't, and just because he couldn't see it, couldn't make it work like that. And I get that. I mean, my goodness, I'm telling you. Look at that bond fund over there that you got 8% a year if you've had it since 1982. But instead, don't look at that. Look at this, where I was going to give you 3.5, and that's before taxes. And he's like, I don't get it. All right, so let's talk about bonds, because I had a guy on my channel just rip me to shreds saying that I'm an idiot. Basically, bonds, he could get corporate bonds paying 5 to 7% that are high. They're with a current yield of 5 to 7%, and you could get them at discount in their investment grade bonds. He just said this yesterday or today, or I can't remember. And I said, you can't, man. You're not getting those three things. You're not getting corporate bonds at 5 to 7% that are investment grade that are trading at a discount. That's just not happening. And so I want to dive into that because I just chuckle at this, and unfortunately, I think a lot of people think this is a possibility. It's not. Now, what this guy is probably mixing up, he's mixing up the total return of a bond versus the yield. All right, the total return versus the yield, two completely different things, and the total return is irrelevant. I'm just telling you right now, it's irrelevant. I'm not going to get into that right now. I might maybe later in this video, but I'll do a different video for sure on this because this is so important to understand. Total return on bonds. This guy was also saying about capital appreciation. And the minute he talked about capital appreciation, I knew he didn't know what he was talking about. There's no capital appreciation in bonds. All right, so let's just put it that way. So, and I'll do a different video on that. But Total return on bonds is fleeting. It's there today, it's gone tomorrow. It's just all there is to it. Because what happens, a bond will always either go bankrupt or mature at par. So if you have a higher total return than the current yield, that total return will slowly dive down and dive down and dive down until the bond matures or it goes bankrupt. Then you'll make any money. So and again, I'll get into that later, but just you got to please, 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 if nothing else, understand the difference between total return and yield. And all right, now again, I'll do another video on that. But right now, I want to do a video what this guy was saying. He could get investment grade bonds 5 to 7% at a discount. No, can't. All right, so let's go into what bond credit ratings are. I think it's actually critically important to understand. So we're going to go to the credit rating agencies, and basically it's the big three: Fitch, S&P, and Moody's. And a lot of people discount the Fitch rating agencies. Moody's is what I typically use. S&P is fine as well. Look, these guys, don't forget, these guys have to get paid in order to stay in business. And so you got to, I don't want to say take it with a grain of salt, the credit rating agencies. But if you look back to 2007 and 8, like all these municipalities were rated like AAA. All these ones were, because they were paying the credit rating agencies to give them a rating in order that they could use that rating to go raise funds. Does that make sense? So if you're Jefferson County, Alabama, and you're desperate for a cash inflow, you could pay a credit rating agency to give you, you're going to give them some money so they can give you basically their blessing. So you can take their blessing and go to investors. Again, that's insurance companies typically and pension companies, and say, hey, we got this good rating from Moody's and S&P, so loan us money. Huge scandals on that. And then they had municipal bond insurance. It's just a nightmare. All right, so you always got to take the credit rating agencies with a grain of salt. But with that said, it's the best we got for now. Unless you're going to do your own research, and trust me, you're not going to do that. So we use Moody's and S&P. Again, Fitch doesn't mean a whole lot in the business anymore. Maybe Fitch has changed. But back when I was learning this stuff, Fitch was always a redhead stepchild. But I don't know. All right, so let's use Moody's. All right, so Moody's, as you can see here, we're going to look at what their investment rate, their gradings are. And we're going to show you, this is going to be Moody's, long-term, short-term, all right? So we're just looking at long-term. You got AAA, basically nothing's AAA anymore. You got AAA to A3, which is upper medium grade investment grade bonds. That makes sense. So you got high grade investment grade bonds, which are AA. You got single A, which are upper medium grade investment grade bonds. Investment grade bonds, and I'll get into the verbiage here in just a second, it just means the credit quality is pretty high. Then you got lower medium grade investment grade bonds, BAA3, BAA2, BAA1. How would you remember that? You just got to look at it. I don't remember. I had to look at this. I can't remember. I just remember BAA. If it's got an A in it, it's going to be typically, or I should say 2 A's, it's going to be typically an investment grade bond. Does that make sense? So just remember that. If it starts with an A or it has 2 A's in it, it's going to be investment grade, which means higher credit quality. But these BAAs are in the lower grade of the higher credit quality, if that makes sense. Then we go down the scale. We got BA1, BA2, BA3, and these are non-investment grade, i.e. junk bonds, speculative, all right? Now, these are higher credit quality of the junk bonds, BA1, BA2, and BA3, and then you get highly speculative junk bonds, all right? So I hope that makes sense. It's important to understand. Then you get your long-term or your S&P, and they have their own credit rating things as well. So just kind of, S&P is actually easier to remember, but the Moody's is one of what I use. All right, so let's go down and see how they talk about it. So here's BAA. This is the lower grade investment quality, lower grade investment grade bonds. An obligor has adequate capacity to meet financial commitments. However, adverse economic conditions or changing circumstances are more likely to lead to a weakened capacity of the obligator to meet his financial commitments. That's a lower grade investment grade bond. All right, so it's still investment grade, higher credit quality, but still lower grade. Junk bonds, and we start with the higher grade of the junk bonds. An obligor is less vulnerable in the near term than lower rated obligors. However, it faces major ongoing uncertainties and exposure to adverse business, financial, or economic conditions, which could lead to the obligor's inadequate capacity to meet his financial commitments. Does that make sense? So if you have lower grade investment grade bonds, it's still investment grade, which means it has adequate capacity to meet his financial commitments. Once you get in the junk bond realm, though, it's less vulnerable in the near term, but any change in the overall economic or financial circumstances could really doom that for sure. So what's going to happen is a lot of pensions and a lot of insurance companies, they're going to avoid by their charter. They're going to avoid anything that's under investment grade. They're not. That's called speculative. They're not going to get involved in speculative bonds. Who dominates the bond market? It's not Grandma Jones. It's insurance companies and pensions and maybe some venture capitalists and mutual fund firms. But generally, it's insurance companies and pensions, governments, if you will, CalPERS. A lot of them, by their charter, will not get below investment grade. They're just not, because they say it's too risky. We've got to make sure we can pay the pensioners if you know when they retire, and if we have a lot of speculative bonds in there, there's a good chance we won't. If you look at 2008 with a high yield bond fiasco, that's exactly what happened. So what happens here? A bond that goes from investment grade to non-investment grade to junk is going to lose. I'm telling you, you're going to see a selling off like a crazy man, because the insurance companies and the pension companies have to liquidate. They have to liquidate. They cannot maintain the holding by their charter. I hope that makes sense. So it is incredibly important for a bond to maintain its BAA 3, 2, and 1, because if it gets re-rated as a BA1, i.e. junk, they're going to lose that in 2 seconds flat. That bond's going to lose its value because the supply, all these companies are going to be selling it, and there's just not that many buyers. The price of that bond is going to drop like a brick in water. Now, what's the likelihood of a junk grade going up? Going to be hard, because once that is deemed a junk bond, the yield that it has to pay to draw money, the coupon to draw loans, is significantly higher than investment grade bonds. And I'll put this in a couple different videos, and I'll share that with just a second. Actually, let's stop there, because I do want to share that with you. The difference between investment grade and speculative bond yields. Once you are here in speculative bonds, i.e. junk bonds, lower than investment grade, you have to pay a significant premium for yields in order to issue bonds. And a lot of these companies, they issue bonds to maintain operations. If they can't get people to loan them money, they can't maintain their operations and thus go bankrupt. Hope that makes sense. So now if I am in a speculative / junk bond status, which I am if I'm BA1, guess what? Insurance companies and pensions are not going to buy my bonds. It's only going to be people in the speculative realm, which will be junk bond mutual funds, will be some more speculative investors. But again, the bond market is dominated by insurance companies and pension companies. And if they are not privy to buy my bonds, I've just, I don't know, 65% of the market is gone in terms of my ability to issue debt. And because of that, it's going to make me have to even issue higher yielding bonds to potential loan lenders because there's just not that much. The demand for my bonds has been reduced significantly once I hit junk bond status. So now I'm in junk bond status. I have to pay much higher credit interest rate. What's that going to do to my bottom line? I mean, my bottom line is I have to have more cash flow out to debt obligations. And I'm telling you, man, it's a vicious cycle. Can it be rectified? Sure. Will you want to invest your hard-earned money on hoping that happens? Nope. Nope. In fact, if anything, it's the other thing that could happen, which is the bond maintains itself or it falls even further. Either way, it's speculative. You don't know. So, all right, let's pause there. Stay for part 2. I'm going to show you what's going on in the market right now. Then I'm going to share with you a story on another article that is written about some of the bonds you should buy, and it will show you how this works in reality right now. All right, okay, so stay tuned. Thanks now.